So, you've spent your entire life saving for retirement. You did the hard part, right? But now comes the really tricky question. How do you turn that big pile of savings, that nest egg, into a steady paycheck that you can count on for the rest of your life? Well, that's exactly what we're going to unpack today.
I mean, this is it. This is the central question that every single person heading into retirement has to face. It's not just about how much money you have. It's about the strategy you use to make it last for, 20, 30, maybe even 40 years? So where on earth do we even begin?
Okay, let's start by framing the problem. We're going to call it the retirement income puzzle. And it's a puzzle because, honestly, it's a much harder problem to solve today than it was for our parents' or grandparents' generation. You see, for decades, things were, simpler. You could often just live off the interest and dividends your portfolio kicked off, the income. But that approach, it just doesn't really work anymore. The world has completely changed. And you don't have to take my word for it. Just look at these charts. They tell the whole story. On the right, you can see that back in 1980, U.S. bonds were yielding a whopping 13%. Today, that number is way down, closer to 2%. And on the left, you see a similar story for stocks. The bottom line is, those traditional, reliable streams of income have pretty much dried up. So with income so hard to find, what do people do? Well, many retirees, very understandably, walk right into something we call the high-yield trap. And it's often driven by a really powerful little quirk in our brains. It's a behavioral bias called mental accounting. And here's how it works. For some reason, we feel way more comfortable spending the income our portfolio generates, the dividends and interest, than we do selling a few shares of a stock to raise the exact same amount of cash. It just feels safer, like we're not touching our original investment. And that feeling, that gut instinct, leads people to build their portfolios using what you could call an ad hoc approach. It's basically a treasure hunt for the highest yields you can find at any given moment without really looking at the bigger picture of risk. And this is what that kind of portfolio often looks like. Whoa, notice those huge chunks? 29% in high-yield corporate bonds, 35% in emerging market bonds. Sure, the income might look fantastic on paper, but you're putting a ton of your eggs in just a couple of very risky baskets. Okay, so if chasing yield is a trap, what's a better way? Well, instead of that treasure hunt, the goal is to build a smarter, more durable portfolio that's designed for the long haul. And the key to this is a philosophy called total return investing. It's a game changer. Instead of obsessing over just the income, you focus on the total return. That's the income plus any growth in the value of your investments. This gives you way more flexibility because you can create your paycheck from either source. It really just comes down to a whole different mindset. The ad hoc approach has tunnel vision. It's all about yield. But the total return approach is about building the most efficient, diversified engine possible to grow your money, which you can then tap into as you need it. Now, have a look at a total return efficient portfolio. See how much more balanced this is? It's way more diversified. You've still got some of those higher income assets in there, sure, but they're blended with stocks and bonds from all over the world. It's just a much healthier mix. And what if you need a little more income? No problem. The total return approach is really flexible. This version is tweaked to target a higher income, around 5%. But notice how it does it. It does it smartly by adding things like high dividend international stocks, not just by piling on more and more risk. But hey, the proof is in the pudding, right? Let's look at the numbers. This table compares all three portfolios we've talked about. That ad hoc portfolio, yeah, it's got the highest income, but look at that volatility, almost 11%. Now look over at the higher income total return portfolio. It delivers a solid 5% income with a higher total return and less risk. That is the definition of a more efficient portfolio. So building a great portfolio is absolutely step one, but it's not enough. You also have to know how to navigate what we'll call retirement's danger zone. These are the outside threats that can derail even the best laid plans. First up is a concept that sounds complicated, but it's super important. It's called sequence of returns risk. And all it really means is that when your returns happen matters a lot. A big market crash right after you retire is way more dangerous than the same crash 20 years from now. So why is that? Well, think about it. If you're pulling money out to live on while your portfolio is down, you're forced to sell more of your shares when prices are low just to get the cash you need. That permanently shrinks your portfolio, leaving you with less money invested to take advantage of the eventual market recovery. It's a devastating double whammy. Okay, the other major danger isn't about the market at all. It's about people. Financial exploitation is a huge problem. We're talking about millions of older investors becoming victims every single year, losing billions and billions of dollars. And it's not always a stranger on the phone. The pressure can come from caregivers or even from family members. But here's the good news. You are not powerless. There are two simple, really powerful steps you can take. First, appoint a trusted contact on your investment accounts. Now, this is not someone who can make trades for you. It's just someone your brokerage firm can call if they suspect something is wrong. Second, you should know that your firm can put a temporary hold on withdrawals if they believe you're being taken advantage of, which gives everyone time to figure out what's going on. All right, let's pull all of these threads together and talk about what this means for you. It's about building a financial action plan that goes beyond just your investments. I love this quote because it really puts things in perspective. A smart total return portfolio is like the engine of your car, but it needs to be part of a well-maintained vehicle, and that vehicle is your entire financial life. Part of that plan absolutely has to include your critical legal documents. We're talking about an up-to-date will or trust and making sure you have durable and medical powers of attorney in place. These things make sure your wishes are known and can be carried out if you can't make decisions for yourself. And of course, it also means getting the fundamentals right. You need an emergency cash fund, so you're never forced to sell investments at a bad time. And you need a good handle on your budget, so you know what's coming in and what's going out. So I'll leave you with this one last question to really think about. When you look at your own retirement strategy, are you just on a short-term hunt for income, or have you built a comprehensive, total return plan that is truly, truly built to last a lifetime?